Hey, Rent Retires. Thanks for joining us here for today's episode. Today is a special day. We're here with Zach Lemaster as usual. Zach, how are you today?
Doing well. We're going to get into some exciting mortgage information. We got the one and only Aaron Chapman, and lots of good knowledge coming your way.
Yeah, Aaron,
Well,
it's
exciting mortgage information. I'm excited to see what kind of exciting mortgage information we got. Hopefully, it's from you, Zach.
So, Aaron, that one thing I read that you can tell me. Well, I think I read. I can't find the articles now. Is it they're considering getting rid of the refinance penalty that they put in, the like 0.5%? Is that coming down the pipeline?
That is coming down the pipeline. In fact, in many places, we weren't even seeing it translating into it anyway. Especially on the investor side, we are seeing it translating in on the owner-occupied side quite a bit. But there are certain price points where it was not pricing in anyway. And the majority of the loans that we're doing for real estate investors were falling within that price point where we rarely saw it at all. So those who, when that time comes and it's announced and say, hey, yeah, this is taken off, people are like, hey, did I get a drop in it? They're not going to see it from us because what we quoted from the beginning is going to be very similar to the other. And the other thing of it is taking it even deeper than that. That pricing hit was put in by the FHFA, right? The Federal Housing Finance Administration.
They're limited to 7%, right?
7% of their entire portfolio for investors and second homes. That means 93% of everything they do has to go for owner occupied. So Fannie and Freddie are the ones who are mandated to charge that. And so since they're the ones charging that adverse market fee is basically what it was, it's not filtering over to our investors right now because we're going to the general market, going to aggregators is what we call them, and be like your Goldman Sachs or your JP Morgans or your big institutions, some of your hedge funds. They're creating pools of money for us to pull from. Interestingly enough, those pools right now, we're locking a lot of people in the very low fours. And what's really crazy is people's like, well, why is the rate so high? I'm like, what do you mean the rate's so high? Like, well, last year I got 3.6%. Why can't I get 3.6%? I'm like, how much news do you watch? Because we had this thing come out in March where the federal government says, Fannie and Freddie, as we just talked about, can no longer be involved or at least limit their exposure to to second homes and investment properties. Now, if we want to take from the time the pandemic hit, so which would be March of 2020, right? I don't know if you guys remember, it was like March 9th, I couldn't lock anything to save my life. And I would sit there and I just run rates over and over and over again until I got a lock window, and I'd lock like 50 loans. And then the lock window would close and I couldn't get anything. Well, then in the 20th of March, 2020, the Federal Reserve kicked in, and through the Federal Reserve and the U.S. Treasury started pumping in $1 trillion, so just a little bit over $1 trillion between March 20th of 2020 to March 30th of 2020. 10 days that dumped in over $1 trillion, right? So during that $1 trillion dump, it brought the mortgage-backed securities right back where they were, the trajectory that they were on before they crashed because of the stock market crash, because of COVID, and then you had all these banks selling their mortgage-backed securities and their other bonds to pay their margin calls on the stocks that they had on margin. And then when you get the market back in place with the Fed, and the Fed continued to dump nearly $10 to $20 billion a day into the market to keep those rates low at that time. And then what they do, right? You go 10 months later, March is when May is when we really had that effect of that rate. May of 2020, with all their money going in, they kept it low until March of 2021. Then they pulled the plug on investors and on second home buyers. And then the rates go up from what would have been 3.6 to now we settled into 4.1, 4.2. We went as high as 5 for a little while there, but 4.142. And people are like, what's going on, Chapman? I'm like, dude, if we took 10 months out of history and set off aside because it's an anomaly because of the Fed dumping in trillions of dollars and because of COVID, then right now are the lowest interest rates in the history of since cavemen were doing with bone tools, right? So when you think about that perspective, people should get so stinking excited about the rate that we quote today, they should not even hesitate.
And I think that's something that interest rates are all relative, right? So when you get people comparing the last 6 months, 8 months, they're always focused on right now. What are the interest rates right now? And concerned about a point, 2.5%, whatever the case is. They're not looking back historically about, hey, interest rates have been significantly higher. and we're still investing, and leverage is a very powerful tool. And we're still, like you said, all-time low interest rates. You're still going to cash flow well and make viable investments. It doesn't matter if you're 50 basis points higher or whatever the case is. And just real quick, for anyone who's not familiar with who Aaron Chapman is, he's one of our main recommended lenders. He's with Security National Mortgage Company. He's licensed in all the states we work in, and he's a professional investor himself. He's an excellent person to connect with just to talk about financing, talk about leverage as a tool. Aaron, we want to get into talking about inflation and using leverage as a powerful tool to mitigate your exposure to inflation. And if anyone's interested to just speak about financing and go through that lending process, we will put you in touch with him to do so. But talk about with the 7%. I mean, this is a kind of high level, I think, for a lot of people to fully grasp. But basically, big picture, what this means is that lenders on the Fannie Mae, Freddie Mac side are limited to the percentage of investment loans and secondary home loans that they can actually offer. So, like, what does that actually mean in layman terms and big picture? And what was that percentage before it was regulated down to 7%?
Well, one, thank you for the intro. I get going, right? I mean, I'm all business. Let's just get into the meat of the stuff. So I appreciate you slowing it down and getting the information out there. So let's backing up to what we were doing before, right? So I only focus on real estate investors. I do about 1,500 transactions a year for real estate investors, which is equal to about 7 every day. And so we relied heavily on our contact, or at least our direct line with Fannie and Freddie, quite extremely heavy, right, to do the loans that we were doing. And they came in, they've audited us a lot and really helped us streamline our operations to be sure that we were able to get things done with them. Well, when we were looking at, we're doing nearly 20, I think there's about 15 to 18% of our total volume within Security National Mortgage Company was for real estate investors, right? And I'm not that full 15%. I'm probably about 9 to 10% of the total volume for the company as far as investors is concerned. Now, when you go to Fannie and Freddie as a whole, they were looking at somewhere in the range of about, I think it was 15-ish to 18% for investors, then second homes another 5+. So they were over 20 to 25% is what they were allocating for investors in second homes. So then if you take that, all the volume they're doing, the trillions of dollars in transactions per year, and then narrow it down to just 7% of that now, we're less than half of what they were doing. It's actually it's more like a third. Yeah, it's a third of what they were doing before can now go towards that second home and investment properties. And you think about that, and I don't know if they're doing on a unit basis or if they're doing it at a dollar volume basis. I haven't gotten that completely verified. And if it's on a dollar volume basis, think about it. Second homes are going to be much more expensive than a investment property. So now you have one of those taken up, maybe several slots for an investment, so for that investor could have taken. So it really is a real interesting play on things. You know, a lot of people say, well, how can they do that? How can the federal government tell these guys what to do? Well, one, you go back into the crash and what happened there. They've taken some sort of percentage of ownership, if you will. And then you get to the point of the mortgage-backed securities. And this is where all our interest rates come from. It's a supply and demand of money. The more money available, the lower the interest rate, just like anything, right? The higher the supply of something, the lower the cost to get your hands on it. The shorter the supply, the more scarce it becomes, the more expensive it becomes. Well, when the Fed dumped in those trillions of dollars over that period of time, even though we got great rates out of the deal, but what did we give up? We gave up control. So now you have the U.S. Treasury and the Federal Reserve now have control of the majority of the mortgage-backed securities that are being released and used by Fannie and Freddie. And now they get to dictate what gets done with that because it's their money being used. Now, it's crazy. It's really not their money. It's our money, right? But they're the ones that are supposedly operating with the capital. So now we had to go to what they call the secondary market, or basically go to Wall Street, form other pools. We had to find other people that put this money together. So a lot of people are freaking out. It's like, are they going to have money for this? Well, think about jumbos, right? Fannie and Freddie can't fund jumbos. They have a loan limit that's right, 540,000. I don't know the exact number off the top of my head, but what's crazy is I look back at when I started in the industry in 1997 is 220,000, right? So now we're 500,000 for a Fannie Mae loan limit. Some counties, high price counties, they'll do a Fannie Mae will have a high priced lending limit. So it's going to be higher interest rates, it's going to be a still a conforming loan, but it's going to be higher interest rate and then go up to 700,000 in some places. But that's neither here nor there because it doesn't affect investors. But ultimately, you've got their limit, and anything that was a jumbo above that, you'd have to go to the regular market to get somebody to fund that jumbo. We've always been able to fund the jumbos. So it's the same sources of money that we've always had. They're just now incorporating doing investor loans, and they're having to wrap their head around the risk associated with an investor, right? There's been this stigma from the beginning of time that investors were risky because it's something they don't live in. But what we have learned is that when you're working with somebody like Rent to Retirement, guys like you guys who train people and educate them on how to purchase a property, properly purchase a property. I mean, that's say that 100 times backwards and flip the property and proper around and see how that comes out. So once a person understands that and they start getting cash flow, right? And then as you alluded to before, Zach, in my conversation I have about inflation and how you're never even paying back the balance because the instrument you're paying it back with is losing value because of inflation. Those investors now are of the mindset, many of them, they'll walk away from their primary residence before they walk away from their investment properties. Fannie and Freddie have discovered that with working with me because of all the audits. In 2016, they went through hundreds of my files to find that, wow, these are actually really, really good paper. I have now 6 years with this company of showing thousands of transactions, and the percentage of delinquency percent when it comes to investors. I think you can count all the investors that I've done, all the loans I've done for Security National for the last 6 years. I think you can count the people that have late payments on one hand, possibly two now. When you consider that versus owner occupied, especially first time home buyer, within the first 1 to 2 years, you'll reach double-digit percentages of delinquency on that portfolio. I've been going 6 years with these guys, just as one company. We have all the data to prove it. So now we have people looking at the data saying, you know, this is actually better paper than we thought. So now there's more options for us to get this financed. But it is going to still be a slightly higher rate than what they would have got if Fannie and Freddie were still in the game. And the reason being is Fannie and Freddie have the government backing. The investors that we're going out to, they don't. They're still new with us. Even though they see the data, they're still new to this. So they're still getting their feet wet. They're still getting comfortable with it. Don't fault these people for an extra 0.25%. Who gives a damn? You're not even paying them the money back with inflation.
Well, let's go ahead, Adam.
Yeah, I'll say I remember I locked and purchased a property with you in January 2020. Aaron's my lender, for those who don't know. And we got 4.5%, and I was over the moon. I was like, man, 4.5% for an investment loan? Are you kidding me? Like, sign me up. Yeah. Can I get 4 or 5 more, 6 more?
It was 4.5 was low in 2020. Yeah. In fact, I remember when we were getting 4 3/4 was the common one up until the COVID hit. And then it was 6% we were locking people at, and 6 1/4 and things like that. And then when it came down to the 3s, I couldn't believe how many people were like, well, you think it's going to go lower? I'm like, I'm going to choke you. If I can reach to this phone, I would choke you.
Well, everyone wants to hold out, right? They're like, well, what happens in the fluctuation? When do I lock? And I think people get so caught up on 0.25%, they kind of miss the big picture. You know, leverage is leverage regardless. You know, I've had loans significantly higher, and I have private money loans that we take out that are double digits. It's how you use it. And over time, I mean, just by the simple fact of having leverage, you know, you're creating a scenario where you're mitigating inflation. You're able to get into a property that's going to appreciate. The loan's going to be paid down by the tenant. It's not even your dollars. Does it have 0.25%? What does that equate to on a $200,000 property? I mean, $20 a month or something. I mean, it's, you know, you really, really should not be focusing so hyper focused on the actual percentage. It's great, but when you're especially talking these lower dollar amounts per deals, it's really negligible. But just to sum up what you were saying, Aaron, basically what you went into in great detail was essentially now we have more regulation, more government regulation. We always love regulation, right?
And more involvement in reality.
That's always a fantastic thing to have. You know, we're all very excited about that. And you know, what that boils down to is it's just a little bit more challenging. We got to always. It's a dynamic lending world. It's a dynamic real estate world. We just have to adapt and stay focused on how we still accomplish our goals and continue to invest. And because of that, that's what we've seen this somewhat of slight increase in rates, but big picture here, we still have all-time low interest rates. And that's what people need to focus on.
Well, I know people very, very they want to time the market, right? They want to be at the right place at the right time all the time to be able to say that they did that. And I know it's not about the money. It's not about the outcome. It's really about being able to say you did it, right? And let's just get right down to the human need. I equate that to a star football player wanting to be on the highlight reel. If he wants to save his energy and sit on the sidelines on the bench and watch it and time it perfectly to run in to get on the highlight reel, it's never going to happen. The only people on the highlight reel have their butts on the field, period. So get on the field and play, regardless of what's going on the rate. A deal is still a deal. You got to find the deal that fits the market and fits that particular situation. And then, I don't know if you want to go down this rabbit hole, but you want to know who really wants people to be concerned with rate, who's really interested in getting people to ask what's the rate today and how can I get a lower rate and all that kind of thing. You know who's into that?
Let's hear it.
The lenders are the one who created that. You would think that's counterintuitive, but the banking industry is the one who forced this consumer mindset. So have you ever noticed how often that we have a refi boom, that people are advertising now is the perfect time to refi? How often does that happen?
You get those letters in the mail that's just like all the time at once. You know what I mean?
Constant. But it's traditionally happens about every 4 to 5 years is what tends to happen. So, and I've been watching this for my entire career because I start off, I was a refi loan originator at a broker. So when you start seeing that that's the pattern, then you got to look backwards and say, why is that the pattern? Well, when you look at a 30-year fixed amortization table, what does the first 5 years look like?
A lot of interest.
It's all interest, right? Like 98% interest. But we know from what I've shared with you guys before, and you guys got a video clip I shot you breaking things down from inflation, that holds a note for any length of time is going to eventually really start to lose money at a high velocity because the dollar is devaluing so fast, especially in today's inflationary environment that we're in. It's extremely high. The Fed's saying it's over 5%. Shadow Stats says it's over 12. It's crazy inflation, whatever you want to believe, right? So if you can convince a home ownership public to decide that it's better to refinance and get that lower rate every 4 to 5 years and keep them in the interest heavy period, so in the first 4 years, you barely pay down your principal. And then you're like, oh, cool, I can drop it from a 6% to a 5% rate, drop 1% because the lenders say that's when you want to do it. But then add $4,500 of my cost on top of the loan. My balance is going to go a little bit higher than what I started with, but I get a lower payment. And now they reset that 30 years and they do it again in another 4 years and another 5 years. If you've got two people on the same street that bought the same house at the same time with the same rate, with the same payment and the same cost, the guy who sits in it at 6% for the next 20 years will be nearly 2/3 paid off, while the guy who refinances it every 4 to 5 years is probably going to still owe about 80% of what he borrowed.
And that's because people they're rate focused. It's all about the monthly payment, right? That's the thing. Can I lower my payment $100, $1,000, not looking at the big picture of it? And that happens mainly with primary residences, but
you'd be amazed at how much, and it bleeds over from primary residence to new investors. And the reason I bring it up, because new investors, we need to help them shake that up, right? They are being forced into that consumer mindset and they're being led around like sheep over a ledge by the banking industry because they can keep them in financial servitude and keep collecting that interest from them. So I try and help people understand is don't play the game. Get in there and do the long term, the tortoise and the hare thing, right? The tortoise always wins, and what you're going to win is you're not only going to win the race, but you're going to drag a trailer full of money behind you.
So let's talk about refinancing for a second then. You talked about how you don't just want to refinance every 4 to 5 years. When do you want to refinance? You kind of have, whenever we refinance and pulled money out to buy more properties on our primary with you, and you kind of had a general idea and a general breakdown of what you need to be able to get out of your refinance for it to make sense. Could you go over that a little bit?
I'm all about the cash out refi. If you can pull cash regardless of what's going on in the rates, and take that capital, and you got to run the numbers on it, right? Anybody who's considering doing this, consider yourself the CEO of your real estate investment firm and looking at all your assets as ways to be able to generate revenue. And if it's your primary residence, if it's another investment property, it doesn't matter. Run the numbers on what that cash is what it's going to yield for you, or you can park that into it and what kind of return you can get on it. Now, of course, your primary residence payment may go up, especially if you pull enough cash out of it. But if you put it into enough assets that are going to generate enough capital, there could be a point where you actually are making way more than what you were putting out before, and you have a bigger spread. So it's a matter of just spending some time to run the numbers. In my opinion, the only time that you refinance is if you're going to pull cash out. Now, let's be realistic, right? If I've got a primary residence loan right now, 2.75%, which is what I have, and then interest rates went negative somehow, I mean, that's possible that it does do that. Well, why the hell would I not do it, right? I mean, at that point, it's just because I want to put that on my headstone. Negative interest rate on my headstone. That's really all it's for.
It's happened
but
in
we
many
all want
countries.
to be able to say that, right? You jumped in at that time because that's going to be a historic move. Other than that, when I'm done remodeling this house, I'm pulling $250,000 out and it's going back into the market.
Well, that's a key point, because it's about what is your plan with that money, right? You're not. It's really not about refining to save $200 a month. It's refining strategically to then go and invest in something else that's going to yield you a higher return. One of my biggest mentors always told me that there's such a thing as return on equity. And if you have equity sitting in a property that's not being used, well, then your return is zero. And that's another resource. That's another tool in the toolbox to go out and reinvest to buy more properties, not go on a vacation or buy a vehicle. It's an asset that's going to appreciate over time and something that you can expand your portfolio with. So that's a great point. Aaron, early on when I talked to you many years ago, and you've done many loans for me personally as well, you gave me a spiel about inflation mitigation and how leverage is an extremely powerful tool, not only to mitigate your exposure to inflation, but just buying in today's dollars and the power of leverage over time. And you were very specific about how the dollar is devalued and how inflation can work against you or for you. I mean, inflation is your friend when you're leveraged, right? And you're also
Right.
those properties are going up in value. With inflation, rents are going up. But can you kind of run through that on a very simplistic, explanation of how useful of a tool is leverage, and why should people really try to leverage as much as you can comfortably?
Definitely. I love going through this because to me, it's one of the most eye-opening things in the world. I'd heard recently that information is not information unless it surprises you, right? If you're being told something you already know, or you're just reminded of something, then you're being reminded. You're not given information. This was actually really staggering to me when I was talking about it on a podcast. And, this was years ago, talking about how inflation erodes the dollar and you're literally winning in the process. But I didn't have numbers to back it up. Well, I got a call from the professor of accounting at Kennesaw State University, a man by the name of John Abernathy called me up, and he was a client of mine. He says, "I heard your podcast. You got to come speak to my students." I'm like, "Sweet. What am I going to talk about?" He goes, "Inflation." He goes, "And we need to figure out a way to figure this out." So he literally built a tool for me that I could run these numbers. And I'm going to have an app. I'm waiting on Apple's approval, and you guys will have the app where you can just run the numbers yourself and see how inflation erodes it. So I'm going to run the numbers here, and I'm going to have Adam do the math with us here. So everybody who's listening here, grab a pen and paper, pause it, do whatever you got to do, write this stuff down, get involved in the math here because it's very surprising to see the sum. So we're going to start with some baselines. $100,000 purchase price, 20% down, a 1% rent to value ratio with a 30-year fixed mortgage, $200 a month in cash flow. And I think that's all the baselines we're going to go off of there, right? So does that sound like an unreasonable deal to you?
That sounds like the deal that would be my low end of what I'd be happy with.
Yeah,
So, yeah.
I mean, not a lot of people get happy about $200 a month cash flow, right? Their cash on cash return is not so sexy. Well, I'd like to tell people cash on cash return is made up crap anyway, right? It's a great metric to fly by real fast and see if it looks good just to stop and look at it, but that's like the smallest end of the deal anyway. So now we're going to get into this. So let's say just for baseline value in the deal, right? You financed 80%. What's 80% of 100,000?
Last I checked, so 80,000, right?
80,000. So that means you invested how much? 20,000. So 20,000 is your investment. If you did your job as the CEO of your real estate investment business, right? You got Zach and team to work with you on one side of it, plus the right people on the ground to source, acquire, rehab, manage, and maintain your business. And you've got people in there for the majority of the time you own it. Who pays off the 80,000?
Your tenant.
Mm-hmm.
The tenants, right? So if the tenant's going to pay it off, it's going to take them 30 years. So let's take 80,000 and divide that by 30 and tell me what number you get.
You get, I believe, 2 2/3, right?
What's the exact dollar amount? I have yet
No.
to ever pay my bill with 2 2/3 dollars.
Fine. $2,666.67.
Precisely. Thank you. So $2,666.67. If you divide that, so that's how much every year, averaged over 30 years, they're basically giving you because they're paying off that note. So if you divide that into the 20,000, I won't beat you up with this math, Matt. I don't know why that came out, Adam. So you actually kind of do look like my buddy Matt, which is actually a good thing. The guy is he's an operator for the Navy, and
He's
you
a
know what those
model.
guys are. So you definitely want to know. So
He's a male model.
If he told
So
me he was a
he's
male
a
model, I
sexy
wouldn't
kind of
believe him.
So what it is if you divide that into the 20,000, that means your 20,000 is actually growing by 13.33% of the original 20,000. Every single year, you have somebody in there just paying off the balance. That's not cash flows. That's not appreciation. That's nothing else. That's not tax benefits. That's not even hedge against inflation. All right. So now we know that there's a 13.33% gain there. Now let's take a look at where inflation comes in. Now we get to raise rents because of inflation, right? Do you guys know what the average rent is going up by right now in the United States?
Oh yeah, we talked about it in a previous episode. It's right now nationwide, it's like 12 or 13%, I think.
Yeah, it's ridiculous. 12 or 13% across the country. I mean, there are places that's not going up that high. In fact, if you go over to, I think it's Minneapolis, Minnesota, it's going down by between 15 and 17. And if you don't understand why it's going down in Minneapolis, Minnesota, go back and look at the last year. You know, when you don't have cops running around there to help you out, you're not going to want to have a really good rental environment. So that's what we're dealing with. That so there are a few places where it's going down. So let's just say in your environment you only raised it 3%. We're going to go off of 3. We're going to use that number in this particular example. So we have a 1% rent to value ratio, and you're making $200 a month off that, right?
Yep.
So that means $1,000 a month rent. You're making $200 a month. Year 2, you're going to raise it 3%. What is 3% of 1,000?
$30.
$30. Nothing sexy. So $30 went up. That means conceivably, depending upon taxes and insurance, we're just going to keep it simple. Your cash flow could have gone up to by $30. So it's down to $230 a month in cash flow, right?
Yep.
So reasonable. You went first year is $1,000 a month, 200 cash flow. Year 2, $1,030 with $230 cash flow. If you run those numbers, that $30 increases your cash flow by 15%. That is a year-over-year gain in your cash flow. Every time you raise it 3% or more, you get a 15% gain on your cash flow. It becomes extremely sexy. And we know it's going up higher than that. 5, 6, 7, 8% year-over-year increases in rent is not unheard of right now. So that right there is huge. Now, where it gets really awesome, does the lender get to raise the payment on the loan because of inflation?
Nope.
No.
Well,
They're going to hit you. I'm right now running the numbers at 4.25%. Let's just say it's 4.25. I can't say that's going to be your interest rate. It could be lower, it could be higher. Each person's different, right? 4.25% is going to have a $393.55 payment every month for 30 years. That's the principal and interest. So that means you're going to pay $80,000 principal. That means you're going to pay $61,678.69 in interest, right? So when you add those together, it's $141,678.69. People are like, man, I got to pay off that really fast so I don't pay all that interest. Hold off. Don't think that way. So we said inflation's about 5.5%. Let's just call it 5 for right now. Let's just say it's 5%. At 5% inflation, the dollar is devaluing by 5% per year, right? The buying power of the dollar. So if you recalculate every dollar as you make that payment of $393.55 for the next 360 months, as you're raising rents, you will see that the sum of all those dollars, when you compare them to the value of the dollar the day you bought the property to the day you pay it off, you didn't pay $80,000. You didn't pay the $61,678 total, right? For a total of $141,678. Your total dollars paid is $73,311.49. That's what you paid. You paid less than what you borrowed. That's why they want you to refi. Because if you stay in the deal long enough, you play the tortoise game, you end up taking from them more than what they gave you. So leverage high, you leverage long, you pay off slow, and get somebody else to pay it back and give you a premium every year.
Yeah, that's exactly. I haven't paid. If you look at my investments, I personally have never paid a single cent of interest. You know, my
Precisely. And
tenants
then
have
you
done
wrote it off as if you did. That's the
Yeah.
other sexy part of it. And then you got to depreciate the
Tax
property, and then the property went up in
benefits.
value significantly. I mean, guys, I can go on for days about the hundreds of percent return and how short-sighted it is when a person gets so caught up on cash return and cap rate. Great metrics. Don't get me wrong, but pro forma is Greek for bullshit. It's not real yet because it hasn't. They're guessing at it. Now, pro formas have to be close, but just know it's thousands of percent return when you see through the real depth of this. If we took the real rate of inflation today of around 12%, you know what you'd be paying in total value over 30 years at 12% inflation? $38,260. You're paying less than what you borrowed.
Well, I think that a lot. This is deep stuff, but it's important and it's crucial to understand in your overall financial plan long term. But I think why people look, especially the newer investor, they're focused on pro formas is because they just don't have a deep understanding of the true benefit of using leverage. You know, we have some people that just they have cash or whatever the case is, they're doing 1031, they want to just buy in cash and hold it. But you know, leveraging does so much for you in the capacity that we just talked about. And I appreciate you breaking it down, Aaron, to that exact amount, but also, you know, just the ability to expand your portfolio and expedite this. Because that was one individual house that we talked about. Think about if you multiply that by 5 or 10 over time, you know, and in my opinion, when you're talking about inflation, real estate is an excellent tool to mitigate your exposure to inflation, and inflation can work for you, like we talked about with appreciation and rent raises over time. But even a more powerful tool above real estate that allows you to mitigate your exposure to inflation is debt, is leverage. And then you couple those two together, now you're playing the system right. And this is how you're growing over time. And personally, a lot of the properties that we buy now, I don't care about cash flow. I want the cash flow to be adequate to support the investment and cover all the expenses. But it's more of a tax game and more of a game of battling inflation and things like this for the long haul. And that's how you build generational wealth over time.
100%. And that was not me crapping on pro formas, because that is a great metric for people to get into, or a great tool for people to, like I said, when you're flying by a market at Mach 2 at 30,000 feet, you need something to get your attention. That's what it is. And when I go off about the pro formas, because a lot of people, the newer investors, they try and live and die by it. And when it doesn't, when the deal closes and it doesn't match it perfectly, they start to freak out. They need to understand that the real depth of everything is what you just said, Zach. There's a lot more to it. This is a very multifaceted investment that if you're having to live off the cash flow on this thing right out of the gate, you got to look at how you're structuring it before you get into it too far to make sure that cash flow situation's right. You know, I've had some people come to me and say, why don't I just pay cash for it? I'll get more cash flow. Like if you put $100,000 into one property, you might make $700 a month cash flow on that. If you raise the rents one time, right, you went from 700 to 730. You can buy 4 properties with $200 a month cash flow at the low end. That's automatically killing it by $100 a month. That's $800 a month cash flow. Then you raise the rents. Now you're at 920. You can just see the compounding growth by spreading it out.
Yep, exactly. Because you have more doors. That's such a key point. So many people get caught up with, I want to retire, you know, today based on cash flow. I'm building my investment portfolio to replace my income, and I'm only focused on how many properties do I need to buy at $300 a door to make $10,000 a month. And we have those conversations, and that's important, right? I mean, because that is possible over time, but it's so short-sighted about what are the more exciting and bigger benefits here of actually investing in real estate. This is more high level, but everything that we purchase at this point, again, it's not about cash flow. It's about using leverage to be able to buy enough real estate so then we can go back and run cost segregation studies and take accelerated depreciation and reduce our taxable income that year. That allows us to have more money to continue to buy more real estate. And you get this exponential growth over time where it's not just, you know, you're focused on 10 houses, $300 a month, $3,000 a year or a month, and that's what you're focused on. So I think this is a crucial. We're probably going to cut up this clip and show this in different capacities, because understanding real estate and leverage to this extent is what's going to allow you to be a knowledgeable and successful investor long term, and to create extremely, you know, beneficial generational wealth over time, and teach your kids how to do the same thing. You're not playing the game of, you know, the 9 to 5 and having to just get in that the same repeating cycle. So this is the exciting stuff to real estate for me.
Well, and it gives the real estate investor the edge that understands this, because you're uninitiated. The people who don't understand it so well and do live and die by pro formas and cash on cash returns and cap rates and those kind of things, they miss this fundamental principle. And because of that, they may walk away from a deal that the educated investor will pick up on all day long. I've seen it happen a lot in my career. If there's anything that I get to witness is people's mistakes when you do it on the scale that we do. You know, I like to say this old saying, good judgment comes from experience and experience comes from bad judgment. That's a great way to learn on the high school or the grade school playground, but not a good way to learn in real estate investing. Learn from the mistakes that others make through your trusted advisors. When I get to see thousands of people make those mistakes, I will give people practical information that they can make decisions with, not speculation and theory. And when you wrap your head around this, you literally become the shark in the waters while everybody else might be shying away from something. It's a phenomenal deal. They just don't understand it. So the more educated you are, the more you understand, the bigger your balls are, the more you're going to be able to accomplish in this. And then, of course, having a ridiculously good team like Rent to Retirement.
Thanks for the plug. And that's so true, though. The only way that you can learn this, and this takes time, is we can talk about it in theory. You can read about it. You can crunch numbers. But the way to solidify it and make it concrete is by actually doing it, right? You just got to buy properties and you got to go out there and actually invest. And then you actually have to see it and see the tax side of it and see how it actually works over time. And that's how you really solidify it. Adam, what else we 100%. Want to run through here?
Well, I want to go over the question that we've been talking about a little bit, but haven't really delved into. Aaron, you talked about a 4.25% rate. If you have good credit and you're looking for a property now and you want to know, like, you know, if you're thinking about locking in the next week or so, what rates are you seeing? Let's go with $150,000 purchase price. Just say 20 and 25%. For both 20 and 25% down. Let's say we have the good credit of 760 or so.
So going into, we just finished August of 2021. So right, this last week in August, we were locking a lot of people commonly. It'd be the 4.1 to 4.2 range for your 20% down for the average purchase price for real estate investments. What's interesting, there's this range in there in the middle, right? The lower priced loans seem to be getting a little bit better deal. The higher priced ones above 170,000 getting a little bit better deal. Somewhere in that middle range, that 120 to 150 seems to be the I don't know, the redheaded stepchild for some reason, but that's the one that's getting a little bit on the higher end of that. But again, it's an eighth of a percent. It doesn't matter. It's somewhere in the range of about $6 a month. If you're doing 25% down, you can break down into the threes of the 3.75, maybe 3.625. I'm not one that's going to advocate going down into the threes just for that lower rate, for that 5%, because that extra 5%, I do have some people are still so wrapped up in interest rate that they'll put the extra 5% down. But I'll ask them, how many properties you plan on buying? It's like, I'm going to keep going forever. I said, so you're going to, the next 4 properties, that 5% you're going to invest in that property just for that extra 20 some odd dollars a month in payment is going to eliminate property number 5 for you. 4 properties will absorb the down payment for property number 5, and property number 5 at that cash flow will always outperform those 4 with a lower interest rate and a lower and more down payment every single time, especially when you raise rents that first time. Automatically, I mean, it already kills it right out of the gate. Then it's just going to start destroying it year over year over year. Every time you raise rents on those 4 properties, you're going to get punched in the face at your bad mistake of putting more money down for interest rate.
It's about building exponential, right? So it all compounds over time. Aaron, I have 2 questions for you that we commonly get. I mean, the first one would be kind of along the lines of putting more money down. Also, are you an advocate for paying points to get a lower interest rate? I mean, that's essentially more capital. And then the second question I have is, can we just talk about what credit score really is the ideal credit score? What's the goal for credit score? So many people are so attached to having a perfect credit. They want to be at 850. They don't want their credit pulled because that might pull them down 5 points for 2 weeks or something like this. I mean, because if I understand correctly, 740 is kind of like the highest tier in most cases. I'll let you speak on this, but talk about how credit is a tool and should be used, and people should be less concerned about their fluctuation in credit.
So credit score 740 is where anything above 740 is all the same price you get as far as how rate is affected by credit score. Okay, so because there's multiple things affect the credit score, but interest rate will have some effect with score. You get to 739 down to 720, it's a different I mean, the rate's not that different. It's about 0.25% in cost. Then you go from 719 down to 700. You get another hit to the cost. You get below 700, 699 to 680. All of a sudden, you're getting throttled. You get below 680, they're just kicking you in the teeth. It really starts to get pretty brutal at that point. And so what I tell folks there when it comes to credit, because everybody calls me, well, is this a soft credit pull? I'm like, well, yeah, if you want a soft pre-qual, which means I'm going to give you a blank piece of paper, sure. You know, if you want me to fully qualify you, that means we're going to look at your tax returns, your pay stubs, your W-2s, your K-1s, your bank statements, everything, including your full credit report. We're going to run it through an automated underwriting engine. You're going to run it through 3 underwriters on my team. One of them's been doing it since 1982. We don't screw around if we send a pre-qual out. We want to be sure that that paper is almost as good as having a briefcase full of money just waiting on the codes, right? So we go through that extent. Now, the credit report is good for 120 days. When it is day 121, I got to pull a new credit report. You can buy 5 properties, 10 properties, use the exact same credit report. We can recycle it. But if you're so worried about your credit score, because I'm at 800 and I don't want to go into the 700s and I've never gone to 700s and all that kind of stuff, then maybe you want to consider whether or not you really want to play in the game, because credit is a commodity just as much as anything else. You're going to invest money. It's going to give you a return. You're going to invest your credit. It's going to return credit to you over time. That credit score comes back. It gets influenced by like 4 points. Now, don't quote me exactly, but I think it's about 4 points. And it comes back over 90 to 120 days because those credit inquiries fall off your report. Now, if you go nuts and just start having everybody pull your credit, yeah, it's going to impact you. Another thing that people need to be aware of, if you come to me, mortgage guy, right? We pull your credit, but it's like, man, I got I'm just one of those type of people I got to check rate. You can call a bunch of other people and have your credit report pulled for 30 days from the day I pulled it, and it doesn't affect your score. As legislation that was passed in 1997, it was put into effect that you can go to the same type of lender. Now, you can't go to me and then go to a car guy and then have a credit card done, then go to an in-store thing, then go get a credit line. Every single one of those credit pulls will affect you. But if it's the same type of loan for the same type of thing, you're allowed to shop very, very, very heavily to be sure you're going with the person you want to. Now, just know also, when I brought that up, that if your credit report is pulled, we don't pull another credit report to fund your deal. But your credit report is a living, breathing document. If you go out there and have your credit pulled, we will know about it. If you buy a new car, we will know about it. It alerts us. So don't think, I got my pre-qual, now I can go buy my investor Porsche because now I'm a super investor. I'm going to buy 2 houses and now I get to drive a Porsche. I'm going to write this sucker off. It doesn't work that way. It'll alert us and it'll tell us that you have a new payment. We have to consider that payment. But we won't get a new credit report. It doesn't tell us new scores. It doesn't tell us any late payments. It only tells us if you're getting new credit. And I think one of the other questions, did that answer the question completely?
Yep.
There was the other part
had to do with
points.
Remind me.
Do we pay points or no?
Paying points. All right. So paying points. I'm not an advocate of it, but in the environment we're in, sometimes you're forced to. You have no choice because the market's going to demand it, because they're trying to attract investors' capital into those pools. And sometimes the only way to attract the investors' capital for certain types of loan is to front load them. Well, think about it this way. When you fund a loan, right, and you have to get the money from the pool through the Securities and Exchange Commission and federal banking regulations and all these audits to go and fund that loan. And then they got to send the paperwork back, and it gets audited like crazy. You'd be amazed how many people look at that paperwork. It costs between $3,000 and $4,000 just to move the money out and move the paperwork back. That's not being charged to the investor buying the house, being charged to the fund and to the pool. Now, if you release $300,000, you'll get that money back at today's rates of interest in probably about 4 to 5 months. But if you release that same $300,000 in $50,000 blocks for a total of 6 transactions, all being charged $3,000 to $4,000 a transaction, it's going to take them years to get their money back. So if they charge you a point or a 1.5 points up front for that, it's going to happen when you're talking about some of these really, really low loan amounts, because you're asking somebody to give you 50 grand for something that sometime in their mind, these kind of people's mind, why don't you swipe your Amex, right? But if you want my 50,000, you're going to charge me 3 grand to give you 50 grand. I'm going to charge you a little bit of something. I'm going to charge you some juice to keep you in the deal. But when it comes to buying down points, just for the sake of a lower rate, that's a conversation we have to have individually. We had one this morning. Scotty's on my team. He understands the market very well. I've known this guy since 1999, and he handles a lot of rate discussions on my team, helping people with the locks. He's licensed in all the states that I am. If he's not licensed in the state, I have that conversation. Well, in that conversation, he will talk to you about the buy down option. Today, it was like $2,200 is what the buy down was, but that rate was going to save the guy just over $100 a month. This guy's like, where else can you put your money in a bank and get $100 a month off $2,200? He goes, that to me is a no-brainer.
So
right. So the guy jumped in it. So it made sense, but it was a big drop in the rate, because sometimes we'll get this pricing model. You'll have the regular rates at the top, but then you'll see this rate way in there that's really, comparatively speaking, fairly cheap. It still costs some money, but when you think about what it's doing for you, we will look at that and we will talk it over with you. We take the deep dive into everything and we decide whether or not it's worth having the conversation.
And that's why it's so vitally important to have someone that is investor-minded, investor-centric like yourself, to actually go through this on a case-by-case basis, so they fully understand. And that's why having a lender that's a professional investor like you, Aaron, and fully understands the long-term goal here, is you're an essential team member. You're an essential person that, and this is why we have you on our recommended list in our team. And that's why Adam and I have both used you for our personal loans, is because we can have these type of high level discussions so you can help us better strategize long term. When you're building a rental portfolio, you're building a business, and you need to have all the right people, all the right key players in sitting around the round table giving you advice, all your advisors, and you are one essential person. And that's why we want to go through on a case-by-case basis and have those type of discussions. But this has been good stuff.
And I really appreciate you pointing that out, ultimately. And because when you're looking at comparing lenders, and there's a lot of great people out there, guys. I'm not trying to crap on any lender out there, but a lot of people, they'll target like first-time home buyers or FHAs or VAs. And great, I'm glad that they do that, because that's not where my target is. I really, really love the conversation with the real estate investor. And a lot of people will get worried, like, man, Aaron's doing 100+ transactions a month. Does he really have time to talk to me? Well, this is what I do. I hired 32 people to ensure the deal gets done so I can have conversation, so Scotty can have conversation about this. And let me tell you something. When you're talking about the average person in my industry, 300,000+ people that do this job, they do an average of 2 to 3 transactions a month. If your deal does not go through, there's a chance they can't bread their table, right? So they're going to use every bit of sales strategy they've ever been taught to help you decide to actually close. Myself, if one of my investors doesn't close on a deal, that doesn't change my life. If I'm closing 130 loans a month, I don't notice that one not closing. That's not to say that it's not important. What that I'm saying that for is, I will look at the deal with you, and I will highly encourage you to look at certain things to decide for yourself if you're really going to do it. Because if you start to fail, I start to fail, and I violently oppose failure. So I will encourage people to look deep enough to walk away so that it does not put them in a position to stop being an investor. It does not affect me to do that. It actually helps me to do that. So know that there's been more than one person in my career I've talked out of a deal. I didn't tell them not to do it. I don't just give them advice. I give them the formula to figure it out for themselves. So now they don't run into that problem again in the future, and know that it do it for not only just for you, but for me. It saves me a lot of headache and a problem. It saves yourself. And it does not affect you. I'm not going to use my sales skills that I've developed over 20 some odd years to talk you into something you shouldn't do. It's not worth it to me.
All right. Well, Aaron, thank you so much for joining us today. It's been an absolute pleasure. Is there anything else you want to tell our listeners before we sign off?
Yeah, this is the first time I've seen Zach Lemaster face to face, and that's a sexy man.
And to sum up the conversation, Aaron, his philosophy about investing long term is also his philosophy about growing his beard. For anyone who can't see him right now, his beard is down past his knees, and he's been growing his beard as long as he's been investing. So, that shows to his character.
Little Rumpelstiltskin said that's not quite that long, and it's as been long as I've been investing too in recent years, but it's quite long. It's down to my waist now. Right, I'll get that fixed someday.
Thanks so much for your time, Aaron. Lots of excellent nuggets.
Appreciate you guys. Thank you for the partnership, man. I sincerely appreciate you guys. It's awesome working with you and your team.
Appreciate it. To all our listeners, head on over to renttoretirement.com. That's renttoretirement.com. You can check out all of the people on our team, and you can reach out to us through the website there. If you want to look at our pro formas, which Aaron so heartily recommended, was just going to renttoretirement.com/hot lists, and you can see all of the pro formas there. They come out. You can also sign up and get a daily email from the website with what all we have. Please go out and give us a review on whatever podcast platform you're listening on. We greatly appreciate it. It'll help everybody realize that we are having deep conversations like this that benefit all investors. And we'll see you on the next episode.